Okay, so let's start. Hello, everyone. I would like to welcome you all to our webinar. I'm just giving a couple of seconds for our attendees to be connected. Now they're getting connected. So let me start. Thank you, everyone, for joining us today at our SFM's webinar on understanding business structure and particularly the role of the non-executive director. As this presentation being made and we go through the presentation, if you have any question, please don't hesitate to put your questions in the Q&A tab, and which is at the bottom of your screen, and then we'll be more than happy to go through your questions and to answer them at the end of the session. I would like to let you know as well that this webinar is being recorded, and it will be available on our social media channels, and as well as we will be sharing this presentation at the end through the link of presentation and the slides that you will be having available to you as well. Let me start by introducing panelists for today. So it's myself, Owais Rifat. I'm the Chief Operating Officer at SFM. SFM Corporate Services is a corporate service provider. We are established in 4 jurisdictions: Dubai, Geneva, Seychelles, and Hong Kong. We are operating in 27 jurisdictions and providing company formation and corporate services. We have with us today Daniel Broby. Daniel Broby is a leading member of the faculty at Strathclyde University at the Department of Accounting and Finance. He worked in the fund management industry for over 30 years across several C-level positions, starting from a Chief Executive Officer, a Chief Investment Officer, and as well as a Chief Portfolio Manager at leading funds managers. And he holds as well several directorships at asset managers. Let's go through the presentation. I think I'm going to pass you across to Daniel today, who will start this presentation and start with the introduction that he has.
Well, good afternoon, everyone, and thank you, Owais. So what we're going to talk about today is good governance, and good governance as relates to the non-executive director. That involves talking about the structure of a board, a company board, and looking at how the vision and the mission of a company effectively shape the direction that that company takes. We'll also talk about how the rules of a company are set out in the governing document and the legal duties that the director has, as well as the stewardship of the assets that he's responsible for. This all comes down to the operating environment of a company and how the directors oversee the work of the organization, and importantly, the Audit and Remuneration Committee, which again, I'll come on to. So, good governance. Essentially, good governance is like a house. It's built on pillars, and all of those pillars have to be in place. Those pillars are leadership, integrity, and we're going to come on to a lot about integrity, because for the non-executive director, that is really one of the prime things that he is there to represent. Decision-making and risk control, obviously, but also to make the board effective. And I'm going to touch on diversity as well, because that is important, and I'll show academic evidence to show that that's the case. But also openness and accountability. And all of that makes the organization have a purpose and a direction. So, good governance. The non-executives are central to good governance because they provide this internal mechanism to make sure that it works. Now, the Board of Governors have a duty and a role to effectively address what's called an agency problem. The problem that the management of a company are not always aligned to what the shareholders of the company are aligned to. And so in that respect, managers and equity holders have this friction. And what you want is a policeman, so to speak, to ensure that that is handled well. And that's the non-executive. But also there are other frictions that occur, like, for example, between equity holders and creditors, between capital contributors and other stakeholders. By other stakeholders, we can mean anything from the regulator right the way through to the customer. So if you want a good academic piece on this, there's a number of papers which I'm going to refer to during the presentation, but John and Zenbet in 1998 effectively did a very good piece in the Journal of Banking and Finance on corporate governance and board effectiveness. What it all boils down to, save you having to read that, is best practice. So it's best practice in decision making. How do you make good decisions? But also, how do you make independent decisions, particularly for the non-executive directors who are there, obviously ensuring this role where conflicts of interest are handled. Likewise, meeting attendance. We had an issue a decade ago where some directors were taking non-executive directorships that they couldn't actually handle. Some people had over 1,000 of them. You can't possibly attend that many meetings. So what you need to do is put time and effort into the success of the company. Likewise, for the board itself, the permanent board, they need to be sure that the recruitment of the right people is done in a way that is systematic and obviously in the best interests of the company and its members, its shareholders. But the board is the strategy piece. It's the piece that does the planning. So you have to ensure that obviously best practice in the way that you determine strategy is actually done. The chief executive has obviously oversight of the company better than anyone else. And in that respect, his interaction with the non-executives is quite crucial. Now, I'll just make a proviso here. What I'm going to talk about today is the single unitary board. That is the Anglo-Saxon approach to boards. There are other board structures. For example, there's a supervisory board structure in Germany where you have a dual board between the strategy board and the supervisory board, which is made up of people from, for example, the unions and other stakeholders of the company. But that's run in a very different way, but the broad principles and best practice still apply. Now, the audit is very important. Now, I'm going to drill down into the audit later on. Likewise, rules and regulations. Yes, we all know about rules and regulations, but bylaws and policies are extremely important to a board. And in fact, some boards even have a policy committee that regularly reviews policies. So then I'll talk about committees and which committees are necessary and which are nice to have, and also how you handle complaints and investigations. So let's now talk about the competency of the board. You want your board to deliver value for the members, shareholders. So in that respect, you have to start to think about what the skills of the board are. What are their competencies and what sort of diversity in the board should you have to achieve that? So you have to begin from understanding that competencies differ between different people. And in that respect, the board should really try to look for differences. When you look at many of the boards 100 years ago of companies, they were very singular in their profile. Male, middle-aged, perhaps older, with similar backgrounds of schooling, university education, and such like, and possibly even the same career patterns. Nowadays, we realize that that isn't actually accretive to value added. So I'll again come back onto that as to how you can improve board competencies. Essentially, what you want is to have the board members bring skill to the table. And again, I'll talk about how to do that. Likewise, the character of the directors and how they interact with things is also important. You can't have someone who's too timid, who is bright and understands all the issues, but essentially doesn't tell anyone about that. They just grumble about it afterwards. That, unfortunately, just being able to understand the direction of the business isn't as the same as contributing to the direction of the board. So what are the attributes worthy of consideration? Self-awareness. So again, it's a personal thing. You have to have people who are director level material. You need people with integrity, and also you need high ethical standards. And bear in mind that everyone you bring on board will impact the dynamics of the board in a different way by their contribution. They will shape and direct it. Their personalities will move the board in different directions. Again, that's why you need diversity. So how do you go about getting that diversity? Well, the first thing you can do is create a matrix. So at the board level, you can actually say, well, what have our directors got and what do they bring to the table? Director A may have industry experience, Director B might not, but on the other hand, he might have a knowledge of broad public sector policy, which may help with the regulators, for example. You may have someone who understands the legislative process. So if you've got a business that you want to effectively move into a new area, say in a digital world where the laws haven't yet quite caught up with the reality of your e-business, if that's what it is, then you might want that sort of skill. And you can map your skill across all your directors and you can see where your holes lie so that you can make a specification specifically for the non-executive that fulfills the criteria you're looking for. So what are those additional competencies? They can be broken up into behavioral, into governance, and into technical. So behavioral, again, I said, bear in mind everyone's individual psychology impacts the board, but are they team players or are they collaborative? Do what they say, does it communicate clearly? Are they sound and their approach logical? Again, we talked about integrity, but do they also have things like listening skills? Can they listen to the employees as well as the management, as well as the board? And can they understand the effectiveness of how decision-making process works? It's not good enough just to get a whole group of people around a table and say you've got a board of directors. You need to have a willingness to devote time and energy in getting that right. And that's governance. Now, in terms of governance, effectively, there's a difference between governance of smaller companies and larger companies. But there's also what you bring to the table in terms of do you have financial literacy? Remember, as a board member, you're responsible for signing off the report and accounts. They are audited by a third party, by an auditor, and prepared by externally by an accountant from your internal financial resources. But you have to make sure that obviously that you are representing a true and fair view to your members, which means signing off those accounts and understanding how they're prepared. At the same time as having these skills, you also have to think strategically, because you want to drive the business forward. And thinking strategically is a very different skill, and from a board perspective is one of the most important things. Now, one of the new innovations that's coming to board practice is something called a deep dive. Because what happens is when you've got all these other things, like your signing off accounts, like going through your various bits and pieces on preparing the policy documents and going through remuneration and so forth, you tend to find that actually that's taken up a lot of your time and you don't have time to think strategically. So what you do is you set aside time in your board meeting for a deep dive into an issue you want to spend time on. And that issue is typically identified at a board retreat, where effectively you just think strategically and get away from the minutiae of management, which is really what a board should be trying its best to do at all times. Again, risk management is important. There's no point having a great company delivering returns if the risk blows those returns up. So risk management and how you handle risk and how the risk committee interacts with the board is again very important. And that comes into the client compliance focus. How do you comply with the laws and regulations that are there? And all of that good governance leads to profile and reputation, which is important to obviously the business and how the business is perceived. Now, having said all that, as though that isn't enough for one person to have or for collectively in a board to have, you also need technical skills. Now, not everyone can have all the technical skills. You can have someone who has a chartered financial analyst or an ACCA on the board for financial experience, but you may also need legal experience, an LLB. You may need someone, if you're an IT business, with IT. And in fact, one of the deficiencies in a lot of boards who don't go through the matrix approach I've just shown is that actually they tend not to have the degree of IT competence in this digital world that they actually need. You also need people who understand public relations. You need people who understand human resources and so forth. Now, the board itself might have those people on the board because your human resource manager might also be a director of the company and therefore is reporting with his experience. Likewise, your public relations manager or your marketing manager may be there or represented as a business development director. director. So again, that comes to why you would want to map the skills. And hopefully those are people of sufficient competence that they're able to guide and direct the board with facts and knowledge so that they can make those strategic decisions. Now, obviously, the CEO, the chief executive, is really the guy who's effectively day-to-day implementing the strategy of the board. And he should have all of these skills and be able to understand and communicate them, and where he's got deficiencies, should definitely go out and hire to meet those deficiencies. So being a director comes with duties, and those duties actually technically don't come with executive powers. So you can have a director who is not an executive, so a non-executive, which is what we're talking about, someone who's there for the oversight and strategy, but is not in the day-to-day management of the company. However, the majority of directors are likely to be employees of the company, and in that respect, they need a contract of employment, and very clear divisions of what they actually are meant to do and what their terms of reference are. Whether they have that or not, both non-executives and directors owe a duty to the company. And likewise, in the event that things go wrong, and no one likes to talk about that, but if you're coming on board as a director, you're also responsible when things go wrong as well. Effectively, if insolvency threatens to the creditors rather than the members, in other words, to the people who you borrowed money from. So, directors are subject to a number of other statutory requirements and restrictions. Now, what I'm going to talk about, I'm not going to talk about any specific jurisdiction, but these typically apply in all jurisdictions, whether you're in Dubai, the UK, the United States, or offshore in the Cayman Islands or whatever, you will have effectively statutory requirements. The most common statutory requirements is clearly to keep books and records, and these have to be kept well, and I'll come back to that later on how you keep minutes. Likewise, there are restrictions on entering into certain types of transactions. So these are related party transactions. Essentially, you shouldn't be buying your house off your wife and putting it into the company at an inflated value or something like that. There's a whole set of related type transactions, and typically, jurisdictionally, these are spelt out by the letter of the law. Obviously, if there's a breach of any duties or requirements, the director can be struck off. He can be disqualified from being a director. But likewise, and this is the important one, he also has personal liability. And I'll come on to that. Insurance can cover that liability. So you can get something called effectively director's indemnity insurance. I would suggest that you really shouldn't take a position as a director unless that insurance has been taken out, because the world is a very complex place and litigation does happen. So your responsibilities then are the strategic direction of the company. Get it going in the right direction through discussion at board meetings, off-sites and deep dives and so forth. But not just a strategy, but you need someone to implement that strategy, the vision, the mission. They effectively have to be the management, and it's your duty to ensure that there is good management, good people, and that they're doing the right thing, which involves monitoring of their activities. Now, in my experience on boards, the one thing that is counterproductive to the above two, strategy and management, on the monitoring side, is the amount of information. You can have too much as well as too little information. In terms of too much information, if you've got a board pack that's sent you a week before, that's 150 pages long, and very important information is included about, for example, an instance of corporate fraud on page 147, paragraph 4, that effectively doesn't correspond to good monitoring. So giving information has to be done in a way and structured by the board in a way that is informative and gets the right information to them in a timely fashion. All of that obviously impacts the strategy, and there's another academic paper that I can refer you to, Stiles 2001 in the Journal of Management Science, which shows the impact of getting all of this right on effectively the direction of the board. So once you've found the right person and you found a good non-exec or full-time board member and you bring them on board, you need to induct them because they don't know enough about the company at that stage. They might have industry experience, but essentially you need to induct them into the way that the company does business. Now, they might want to change that, but that doesn't matter. You have to show them how the business model works, what the drivers of profitability and performance are at that stage. And then, as part of that induction, you need a thorough review of what happened at least over the last 12 months, if not before, which means going through all the board papers and minutes to understand what the current issues are, to make them effective, hopefully from day one. So before they go to their first board meeting, they have this. I would suggest meeting with key executives and actually interviewing them. 1 hour with the head of each division. Now, some companies don't do that because it's time consuming or whatever, but I think that that gives more depth to how you look at a business. And personally, I also like to do a site visit. That comes from my background in fund management, where I like to actually see the nuts and bolts of how a business is doing. You learn a lot from site visits, whether the server is on its last legs, 20 years old, and sort of in a room that's got an air conditioner that's faulty. That tells you a lot about the IT as much as speaking to the IT director who tells you he's got state-of-the-art equipment. And then obviously you need to have the regulatory and governance issues explained to you in a way so that you know your responsibilities depending upon the industry vertical that you're in. So let's take a case study, and this one you probably have all heard of, Enron, an energy company that decided it would be better going into trading energy rather than producing it. In 2011, World Finance awarded Enron the Corporate Governance Awards, probably the most embarrassing award ever given by World Finance, because as you know, Enron was one of the biggest financial frauds and collapses in the history of the United States. So what did they do wrong? Well, they didn't separate the CEO and chairman. Effectively, they only have 1 woman out of 17 board directors. They put on their board several industry insiders and politicians. Why? Because they were big names. In 1999, before this 2011 award that they got, they actually waived their code of ethics. A really big red flag. Effectively, then what they did was they started estimating profits and then booking those estimated profits. Again, another red flag. That should have come up in the discussion during the audit process. So again, I'll come back to the audit process and how to do that well. But obviously, when you've got high-profile politicians on your board and you've got sort of trophy board members rather than functioning board members, some of these things can get missed. So essentially what this was an aggressively trading financially derivatives company, in other words, an unregulated bank that essentially was using leverage off-balance sheet instruments, and therefore when it went wrong, it blew up. So in terms of the structure of the board, another academic paper you can look up if you're interested, Link, Netter and Yang, 2008, who delve into the determinants of board structure. And everything I'm saying about board structure comes from academic evidence. So it's not just my own thoughts on what makes good governance. It's what makes good governance deliver value to a board. And in that respect, there are different models, but broadly speaking, as the diagrammatic shows, you've got your board of directors and you need a company secretary who's recording and keeping those records, and that board of directors effectively oversee the executive committee. And they do that through effectively the audit committee, governance committees, and the remuneration committees, and a bunch of other committees. In this enlightened day, maybe a CSR committee, a board of code of conduct, or a risk committee. So all of these things add up to good governance. So the chair, notice I didn't say chairman, again, more enlightened these days. The chair of the board is very important. And in fact, as I've just said from the Enron case study, it's probably a good idea to separate the chair from the CEO role, so that there's someone to keep heads apart or bang heads together as needs be and to keep you to your agenda. Again, if you want to know more about the chair, another academic paper, Coles and Hesley 2000 from the Journal of Management. So in terms of the role of the chair, he's obviously making sure that the objectives of the meeting are met. He's setting the agenda. So he's actually very important in that respect. If you think of the board as making strategic direction, if you're setting the agenda, you've got the ability to set the agenda of which way you're going to head towards your strategic agenda. And he's obviously responsible for everything that's recorded and carried out in that respect, and to ensure that all the policies are up to date and kept and updated as they go along. I would suggest that he is there to ensure that there's full participation. Non-participation at board meetings results in poor governance. Now, obviously, somebody can be ill and not attend or whatever, but I actually think it's a good idea to report board attendance in your report and accounts, because then you can actually see if your board members are being good on their attendance or not. And obviously, keeping strictly to time limits, unless it's warranted to extend them. Obviously, it's all very well being very good at time, but there's also the issue that you want to be able to go into an issue if you identify an issue that needs more time spent on it. So let's talk about the company secretary. Essentially, this can be an in-house position or externally outsourced, and they maintain the statutory registers, including the register of members. If you do it in-house, I really suggest you get someone who is chartered or certified to do that as a dedicated role. Outsourcing it is cheaper than hiring a dedicated person, but it is very important to ensure that all the statutory forms are filled promptly. Why wouldn't everyone outsource it? Well, one, cost. Sometimes it can be very expensive for very small companies. For large companies, I would suggest you do it unless you have very specific industry level regulatory issues, like, for example, in financial companies. So, for example, a pension administrator that I was on the board of, we needed an in-house, effectively, company secretary, because there were a number of things that we had to do with the pensions regulator that were in addition to what the outsourced company secretary would know about outside of their purview of knowledge. Likewise, they should be able to be on top of all the deadlines and so forth, and keep the auditors and members duly informed of meetings and so forth. Remember that when you're signing an audit, you need the auditors to come and present to the board of directors. You need to fit in also with other people's busy schedules. You can't just suddenly announce a meeting and expect someone can sign off on a report and accounts and expect that a highly paid auditor is necessarily got that time in his diary free. So there's a lot of coordination in actually getting the board going. And I would also say that actually it's quite important to have a budget for the board. Many people think of this as essentially a group of people meeting or whatever, but when you meet off-site, on-site, or whatever, it can be an expensive process when you get sort of 10, 15 people, even 20 people together, coordinated with their travel and so forth. So again, just another aside there. Then you need to obviously ensure who has access to what information, who can review what, and effectively what is done in terms of custody and when you sign off on documents. Obviously, you're only applying a seal to a document once a resolution has been made by the full board of directors. So as a result, these are very important functions of the company, and also who the signatories of the company are. All too often, companies forget to update their signatories with, for example, banks. If you've got 15 banks and one of the directors has rotated off, sometimes the signatory people forget about that. And that actually is not good governance, particularly when you're talking about finances like that. So in terms of taking minutes, what do you want to do? You want to record and document. So just be really clear about it. You've got to give due notice. Make sure that there's a minute book that can be inspected, and you want to record obviously who's present, who's chair, and who's taking the minutes. That's also important because obviously you don't want too much wordsmithing of the minutes taking place. And obviously if you vote on resolutions, you need that recorded, because that is, you are legally binding the company when you vote on a resolution. But also when you're having your meeting, make sure that when you come to a decision to do something, we're going to start a new business line, assign responsibility. You put somebody's initials, 2 initials, to do that, to assign that responsibility. Likewise, who's responsible from a management point of view, from actually doing it day to day, and who's responsible from a board point of view, in other words, for ensuring that strategically it takes place. So 2 sets of initials if something is strategic. And also the time frame. Don't just give open-ended, we will do this. That's not very helpful if you want to have a tightly run ship. Likewise, referral to board committees and so forth. So if it's an important issue, but if you don't want to take the board time to do it, subcontract it to a board committee, and the board committee can just report the conclusion to you. Like, for example, find a new hire for human resources. We don't need to spend time doing that at the board level. The Remuneration and Executive Committee can do that for us. When you come to the minutes, read and review them. Make sure that actually they are a proper legal record of the facts and who said what, and be sure that at each board meeting, you review them line by line. And I'm quite serious about that because these are legally the record of your meetings. And then after you've gone through the minutes, it's good practice just to review last minutes and see whether each of those actions has been taken place. And I would suggest you have an Excel or some format where you can record the progress and say whether an action is closed, open, on time or not. And in fact, like the accountants do, color coding red, orange, green as to whether or not actions have been actioned. So the mem and arts and articles of association, so the rules setting out the governing document, and SFM will help you with that. So that's obviously something I don't need to spend time on, but you know, they are the power documents of the company itself and how voting and election of officers and so forth are done. So as a non-executive, you have to be familiar with your own mem and arts, and obviously reading them through is a prerequisite for the job. I've said a lot about the vision and mission of a company, and actually every company should spend time on their vision and mission. In fact, I've been on boards where we spent many hours just wordsmithing the 1-2 sentence vision and mission. Why? Because it's so important. Every word matters, sends a message about what you want to do. You know, do you want to be socially inclusive? Do you want to be a leader in the field? Do you want to be globally leading? These words actually all matter when it comes down to the organization and gets down to what people are reading from the board. Remember, not every worker, employee of a company is privy to the board, and therefore they get a very distilled version of what comes from it. So you have to be precise as to how you communicate. So there are legal duties. Obviously, following the company's constitution is the most important, and promoting the success of that company. Exercising independent judgment, but there's also the duty to exercise reasonable care, skill, and diligence. And in that respect, you have what's called a fiduciary responsibility. Now, that's a word derived from the Dutch that's been sort of co-opted into American language, but the fiduciary responsibility, the way I view it, is treat it like it's your own. You know, how would you like to be treated? And so you have a very high bar, because hopefully you treat yourself and your family very well. And obviously not to accept benefits and inducements or whatever from third parties and so forth. So in every jurisdiction you have anti-bribery regulations and such like, and also things like anti-terrorist regulations. You have to be aware of what those regulations are and how they apply to you. Not every jurisdiction has them, but what every jurisdiction does have is taxation. The two things certain in life, which is effectively taxation and death. So the company is responsible for paying corporation tax, but also for things like value-added tax, payroll tax, and obviously making sure that all those are filed and correctly reported for. And you, as a director, are legally bound to ensure that that happens in a good way. There are obviously, on top of those, a whole bunch of other laws, and I don't need to go into them in time, but it's health and safety. You can't have you know, your employees tripping over and ending up in hospital for a long period of time. Likewise, there are consumer rights. The people you sell stuff to, are you selling it in a fair way? There's competition law. Are you doing the right thing in a competitive environment? Nowadays, in the digital world we're in, your data is valuable. So there are global data protection regulations that also you have to be cognizant of. And in some jurisdictions, you can actually get fined, like for example in Europe, a percentage of your global turnover if you breach these. So not only is it important to make sure that you've got it correct and that you don't let any crazy hacker get into your system and steal your data, but you actually have to be sure, because this could actually be something that could really impact the bottom line of the business. Are you licensed? Do your products have patents? What about food safety and hygiene, intellectual property and so forth? There's a whole lot of stuff that comes into it. And I haven't even mentioned the legal requirements of regulated industries, but in my industry, finance, obviously very important, but likewise the health industry, producing vaccines, as you all now know. Industries like the nuclear power industry, clearly you've got to understand the legal the law and regulations relating to that. But all industries have some degree of regulation. Personal liability, yep. Well, as if all these skills and attributes and getting it right and so forth they sound overbearing for the role of a director. The role of a director also comes with personal liability. Now, companies have limited liability, but that doesn't mean that you, as a director, don't have that. If you're, say, an entrepreneur and you put your house on the line to get the loan to push the business forward, you might have signed a personal guarantee. Then, regardless of what you do on the board, you are personally liable. Effectively, if the company is trading in an insolvent manner and you haven't proposed effectively winding down the company or seeking new capital or something like that, then you're personally liable for that. What about the assets that you dispose? Well, you have an obligation to do that at arm's length valuations. And obviously people have the right to question transactions if that's not done, and you could potentially have personal liability if the right advice has not been sought on disposal or acquisition of assets. Hence the reason why our friends in Wall Street get such nice fees for that sort of business. What about how effectively you interact on your finances with a company? Lending from a company to an individual in certain jurisdictions is totally prohibited. But what happens with associated companies and so forth, and what happens with employee share option schemes? All of these need to be looked into, and probably best to bring in external advice to make sure that you're doing the right thing. And remember, I said the board should have a budget. As a non-executive director, you should have a call on that budget to bring in professional third-party advice where you don't know something. So if you don't know whether or not a certain transaction is right or not, you should bring in independent advice and have the board budget pay for that, so that at least you're giving your best advice. So it's all about core values, setting and safeguarding these visions I've talked to. You've got to have a common sense and purpose. So I've talked about the diversity of a board, but actually you've got companies have their own identity, and you need to obviously preserve that identity. Some companies have a corporate identity, a social identity or whatever. They are there to do something for the local community as much as something else. You need to preserve that and obviously communicate that, as well as providing this long-term direction and communicating internally. So a lot of boards make the mistake of, I'm very important as a board and director, non-executive director, let's communicate externally, and they forget about the internal communication of what they're trying to do. And remember, there's this difference between management and the members, this conflict of interest. So you want to ensure that the message of the board is also being communicated properly internally. And I would say that some other values come into it, like inclusiveness, participation, quality, and openness. But those obviously come with the individual as well. So we're talking about stewardship of assets. That's what you're doing. When you're on the board, you are responsible for making sure that other people's money, their investments, the members, the shareholders' investments, are looked after, the company's equipment, goods and properties are secure and are effectively making a return on the investment that has been made in them. And so in that respect, the non-executive needs to ensure that all these assets are well managed. Having a carpool is fine, but you need to make sure that those cars are maintained or whatever, and that's properly depreciated on the balance sheet and so forth. So just buying a car for a director is not the same thing as being responsible about the way that you do it. And then I put in red here, first one I put in red, the non-executive has to be prepared to resign. He's got to be prepared to say, okay, you don't do it this way, I don't feel comfortable with this, and I resign. And this is why a lot of the people who become non-executives are very high profile, because their reputation is worth more than the salary they bring from the non-executive position. And sadly, that's why there's a bit of a glass ceiling as to how to become a non-executive, because obviously for most people, the salary of a non-executive is something which is more enticing, and therefore they tend to pay lip service to a powerful CEO not prepared to resign. This is a very personal issue, but I just think that people have to think about this with their own integrity. And all of that comes down to the operating environment of a company. That's all continually changing. Every board meeting will be different. The non-executive has to be on top of that and ensure that all the policies and services and everything fits into how you do it. Now I'm going to go very quickly through the next slides, because these are typical business school stuff. So you can read them at your own, but you can do, when you're determining strategic direction, you do SWOT analysis. We probably all know that: strengths, weakness, opportunities and threats. I won't spend time on that. You need to understand the drivers of the business, not just from a financial perspective, but from the customer perspective, internal customer perspective, learning and growth, and the business process. Less known from a business school perspective is what we call Pest Analysis, which is political, economic, social, and technological. So this is why some larger companies have politicians, for example, on the board, to get the holistic, larger societal oversight issues there. You can read the headlines in your own time. The management committee should have an understanding of those, but it's part of the board and the non-executive to give the strategic view from that. You know, how is taxation and politics influencing our business? What about regulation? Will it change in the long run because politics is going to change? Sorry about that. All these things are important discussions. And likewise, sorry, the other one I showed you was 5 quarters. This one's the SWOT analysis. In terms of overseeing the organization, this is where we come to the committees and so forth. And obviously no one is expected to be an expert, but this is where the non-executive needs to be sure that the committee work is being done in the right way. Audit and Remuneration Committee are vital, and every company should have it. There's 2 pieces of academic works here, Gafflan and Sullivan 2013, Canyon and Perk 1998. Essentially, they found that independent audit committees effectively delivered better results. And I'm not surprised by that, but it's an academic fact. And that top management pay is better overseen by effectively having a remuneration committee. So I would strongly recommend every board have an audit and remuneration committee. The audit committee is responsible for both internal and external, and mostly down to objectivity, structure, risk management, staffing, and how the timeline of the audit is actually done. So anyway, I'm talking about timekeeping to the end of the thing. We wanted to leave some 15 minutes for Q&A, but what I want to do is probably touch on the point that most people like to hear about when talking about non-executives, which is, what do you get paid? Well, here there's a split and a dichotomy between the size of the company. Now, obviously, we all know that the directors of very large listed companies on the New York Stock Exchange, Dubai Stock Exchange, or London Stock Exchange get paid in obviously very large sums of money, potentially up to millions of pounds. However, the majority of companies are, in terms of number rather than size, are what you would call small, medium enterprises. And in that respect, there's a difference in pay between what you get based upon what industry you're in, largely because that depends, also impacts the sort of size and market dominance of your company. So pharmaceuticals for non-executives tend to be, in the data on the chart on the left comes from Standard & Poor's, from SFM Analytics. The non-executives in the pharma industry tend to get the most, and the banking industry, ironically, tends to get the least as non-executives. So although the bankers themselves, the executive directors, tend to be known as the highest paid, their non-executives don't, probably because of the scrutiny that's gone into their salaries. But obviously there's a hierarchy, and it goes down from there to what you get from smaller companies and so forth. And smaller company board, from a non-executive point of view, still need to pay fairly well, because remember what I've said about personal liability. So to conclude, what do we have? We're talking about good governance, reducing these agency problems between the members and the board and the management. The non-executive is central to that. You really should, as you've heard, there are all these issues. So the non-executive is there to police the board. But by being a policeman in that respect, he has both legal and moral responsibilities. But he should also be bringing skill to the table and effectively his experience on how to deal with various issues. So there's my own compliance disclaimer, and I'm open for questions, and so I'll return you to Ois for that.
Thank you very much, Daniel. Let me give you a couple of the questions that I have already received. So the first one is stating, is a non-executive director liable for actions or wrongdoings of the company just like a regular director? Taking an example, when there are statutory violations by a company where directors are also deemed culpable of that?
The answer to that is yes. As I said, the directors have liability. And what you should do is ensure you've got directors' liability insurance. And bear in mind, you can be liable for a whole lot of stuff which you wouldn't think you're liable for. Corporate homicide is a thing in some countries. A company can be guilty of murder, and the board of directors ultimately is a responsible entity in that respect. Likewise, bribery and corruption. If the company officials knowingly give and make bribes or take them, you can be responsible for that under certain anti-bribery legislation, particularly, for example, the legislation we have here in the United Kingdom.
Okay, thank you very much. Another question. It states, I have seen some board having a fair number of non-executive directors. Is there a limitation or any limitation on the number of the non-executive directors on the board? If not, do you have a suggestion on what and how many would be as a reasonable ratio between a non-executive and an executive of board?
Well, firstly, the restrictions on the numbers would come from the Memorandum and Articles of Association, which SFM would help you with in that respect. But there is no correct size if it's not there. However, there are optimal sizes for making decisions. And there is optimal sizes for having efficient and short meetings. And there are also optimal sizes for avoiding having this CEO run roughshod over some of the better input he gets from a board. So my view would be that actually you do definitely need an independent as well as a non-executive on the board. More than one is of each is better. It would be nice to see an independent chairman as well, and the rest of the board composition from executive directors. The more non-executives, the better, until you start getting to the law of diminishing returns. So a board of 25 will just be ineffectual, in my opinion.
Okay, thank you. Another question. it says, can a director refuse a decision that is already made by the board of shareholder or even a board of director? In other words, can a director, we understand from your slides that he has the right to resign, or he needs to prepare himself to resign in case he would like to take an immediate action. But can he refuse without resigning? Will there be an impact of his refusal of taking a certain decision?
Yes, of course. Well, of course, the directors are not taking, they're not directing themselves, they're directing the management. So the director wouldn't be obviously being directed to do something. However, what happens is that when you come to make a decision that impacts the business, you will make a resolution, and that will be recorded in the board minutes. And you can, as a non-executive, effectively vote against that resolution. You can abstain from that resolution, and that will be minuted and documented. You don't need to resign. You can just say, I'm sorry, but I disagree with this, and I would like that documented.
Okay, well noted. What if within a certain number of years, a non-executive or even an executive director, after a number of years, let's say of about 5 years, he resigned from his exercise in an X company, and then after 5 years, apparently following a certain audit, an issue appeared in the past when he was actually a director and he signed on certain decisions. Will he be liable, and for how many years actually his liability will stay?
Yeah. Firstly, before I answer the question, I actually didn't mention that there should be regular rotation of directors. Why? Specifically to stop that sort of thing happening. So a term limit of 3 years, or have to be re-elected after 3 years. So yes, in terms of the corporate liability, his liability is when the decision is made. So just leaving the board doesn't necessarily take the fact that he made decisions in the past. And certainly in many high-profile fraud cases, the person who's perpetrated the fraud has long since gone, but obviously is culpable and sadly not enough of them get put into prison, but obviously, as you know, some of them do.
I agree, it makes sense. I have another question here. Can we apply all these principles that we have discussed today for the non-executive for a non-profitable organization? Would that apply for it same as it applies for a company?
Most certainly, yes. I've been on the board of a few non-profits, and in fact, they are typically the champions of good practice and so forth, because they're member-led organizations. They have people who have got charters or are paying subscriptions, and so they very much like supported on volunteer time. So yes, they most definitely require good governance.
Okay, well noted. One more. So, what if a non-executive is absent to a meeting, a board meeting, and the decision was taken at that time? However, he was absent to that decision. The decision was taken, and it seems that there is an unethical decision made. Precautions are already in place. Would he be liable for something that he did not sign on? He was not present during that meeting.
Yes, well, all directors should be informed of meetings in a timely fashion with a board pack that will give them the resolutions that will be voted on. So essentially, if he has seen the board pack and there's a resolution, he should have given his voting intentions on that resolution, even if he can't make the meeting. In terms of what happens if there's a resolution just bubbles up in the meeting, well, obviously, if he's not there and that happens, individually, he's not responsible, but obviously there is still board. Again, it comes down to why you need board insurance, directors' indemnity insurance.
Okay, thank you. I think I'll take one last question for today. As a director or an executive, is it okay to assign a duty and immediately take action by taking on the duty himself?
for the director to suggest something and then do it himself.
Yes.
If he's an executive director and it is approved by resolution, then yes. Obviously, a non-executive director has no executive power, so for them the answer is no.
Okay, thank you very much. Well, I think we are getting close to the end of our session today. I would like to thank you very much, Daniel, for your input and for the valuable information that you have shared with us today. Thank you all for our attendees. We have had with us 285 attendees that were registered with us today. I would like just to let you all, if you have any questions, please don't hesitate to contact us again, and we'll be more than happy assisting you offline and taking this discussion further. So thank you again, Daniel. And for those who were leaving us comments on the chat, yes, we will be sharing the link of video and the slides with you so that you can have it and you can go through it again. If you have a last word, Daniel, I'll just leave it to you.
Well, no, just thank you everyone for listening. And as I said, it's all about best practice. So let's make the world and the companies we work for a better place.
Thank you very much. Appreciate your help today, and thank you for being with us. Keep safe, everyone, and wish you all to have a good day. Bye-bye.